When conflict flares in the Middle East, the effects do not stay in the Middle East. They ripple across the entire planet, showing up in the price you pay at the gas pump, the cost of your groceries, and even the decisions made by the most powerful bank in America. Right now, a major oil shock is doing exactly that, and it is throwing carefully laid plans into chaos. So how does a faraway conflict end up squeezing your wallet? Stick around, because the chain reaction is eye-opening. So what actually happened to trigger this? A conflict in the Middle East disrupted the flow of oil. A huge share of the world's oil travels by ship through a single narrow waterway in the region. When tensions in the area threatened and then choked off that route, the world suddenly faced the possibility of far less oil reaching the market. Since oil is the lifeblood of the global economy, even the fear of a shortage sent shockwaves through markets almost instantly. How much did oil prices actually jump? Dramatically. As the crisis unfolded, the price of crude oil surged, at one point climbing past $120 a barrel. Over a short period, key oil prices rose by around 50%. For everyday people, that showed up fast at the gas station, where prices climbed to their highest levels in years. When it costs more to fill up a tank, that pain spreads quickly through the rest of the economy, and that is exactly where the trouble begins. This kind of sudden spike is especially painful because it happens so fast. Unlike many slow economic changes, an oil shock can hit within days. 1 week fuel is affordable, and the next it is eating a big chunk of a family's budget. That speed leaves little time to prepare or adjust, which is part of what makes energy shocks so disruptive. People feel the pinch almost immediately, long before the deeper effects work their way through the economy. Why does the price of oil affect so much more than gas? Because oil is in almost everything. It powers the trucks, ships, and planes that move nearly every product you buy. It is used to make plastics, packaging, and countless goods. So when oil gets more expensive, the cost of producing and delivering just about everything goes up too. That means higher prices on groceries, shipping, and all sorts of items, which is the very definition of inflation creeping upward. What does this have to do with the Federal Reserve? Everything, actually. The Federal Reserve is America's central bank, and one of its main jobs is to keep inflation under control. It does this largely by raising or lowering interest rates. When inflation is high, it tends to keep rates high to cool things down. When the economy needs help, it lowers rates to encourage spending. This oil shock landed right in the middle of some very important decisions about those rates. So how did the oil shock change the Fed's plans? It threw a serious wrench in them. Before the crisis, many people expected the Federal Reserve to start cutting interest rates, which would make borrowing cheaper for everyone. But the sudden jump in oil prices reignited fears of inflation. Worried about rising prices, the Fed chose to hold rates steady instead of cutting them. The relief that lower rates would have brought was suddenly put on hold, thanks to that faraway conflict. It also puts the Federal Reserve in a genuinely tough spot. Normally, if the economy slows down, the Fed can cut rates to give it a boost. But if it cuts rates while inflation is climbing from expensive oil, it risks making inflation even worse. So the Fed can end up stuck, unable to help a slowing economy without fueling higher prices. That difficult balancing act is exactly what an oil shock forces upon the people steering the economy. Why does holding rates steady matter to regular people? Because interest rates touch your everyday life. They affect the cost of a mortgage, a car loan, and credit card debt. When rates stay high, borrowing money stays expensive, which can make big purchases harder and squeeze household budgets. Many people were hoping for lower rates to ease that pressure. The oil shock delaying those cuts means the financial squeeze many families feel is likely to last longer than they had hoped. Is this the first time oil has caused this kind of trouble? Not at all, and history offers a warning. Decades ago, major oil shocks in the 1970s led to a painful period of high prices and a struggling economy. Economists worry about repeating that pattern, where expensive energy drags down growth while pushing prices up at the same time. That combination is especially tricky because the usual tools to fix one problem can make the other worse, leaving policymakers in a very difficult spot. How are global markets reacting to all of this? With a lot of nervousness. Stock markets around the world have swung sharply as investors worry about the effects of pricier oil and stubborn inflation. Some countries that rely heavily on imported oil have been hit especially hard. The uncertainty makes everyone cautious, from giant investors to ordinary savers. When the world is unsure about energy and inflation, that anxiety tends to spread through financial markets everywhere. In the meantime, there are small steps people can take to soften the blow. Being a little more mindful about fuel use, planning trips efficiently, and keeping an eye on the household budget can all help during a pricey stretch. None of this fixes the global situation, of course, but it can ease the personal pinch. Staying calm and adjusting where you can is often the most practical response to forces far outside your control. Is there any good news in this situation? Thankfully, yes. Many experts believe that if the conflict eases and oil begins flowing normally again, prices could settle back down over time. Oil shocks driven by conflict are often sharp but temporary. If supply recovers, the inflation pressure could fade, which would eventually give the Federal Reserve room to lower rates after all. So while the current squeeze is real, it may not last forever if the situation calms. What is the smartest way to think about all this? By staying informed and steady rather than panicked. Understanding how these pieces connect, from a distant conflict to your grocery bill to interest rates, helps you make sense of the headlines. It is a powerful reminder that the global economy is deeply linked and that events far away can reach right into your daily life. Knowledge here is genuinely useful, helping you plan rather than simply react to scary news. This whole situation is also a powerful lesson in how connected the modern world really is. A decision made by a few people in one region can send oil prices soaring, which nudges up the cost of a loaf of bread halfway around the globe, which then shapes the choices of a central bank. No country is truly an island anymore. Understanding these links helps ordinary people see the hidden forces behind the prices and headlines they encounter every single day. So the big picture is clear. A conflict in one part of the world disrupted oil, which pushed up prices, which fueled inflation, which forced the Federal Reserve to keep interest rates high. Each link in that chain connects a faraway event to your everyday wallet. It is a striking example of just how connected our world really is, and how something happening thousands of miles away can end up shaping the money in your pocket. Just a quick reminder, this video is for information and entertainment only, and is not financial advice, so please do your own research before making money decisions. If this made the news make more sense, give it a like and subscribe for more. Money Matrix Kingdom has more coming.